Now that you understand the entire trade cycle in terms of how money flows from the buyer's account to the seller's account and the equity shares move from the seller's account to the buyer's account, a common question that gets asked is, why do companies need to come and raise money from investors? Why can't they just go and raise the money from banks in the form of loans? To understand this, you must go back and revisit the debt session. A bank cannot be investing its money endlessly into equities because the bank needs to manage the asset side and the liability side of its balance sheet. When a bank borrows money from a depositor, they have to give this money back to the depositor along with the assured return of 7 or 8%. That is the return they promised on the deposit. The bank in turn tries to invest the money in those avenues which will give the bank a steady return. So it will try to put its money in a particular avenue where it can lend the money at say a 10% return, so that it is a steady stream of income wherein 10% is what the bank earns, it pays the depositor 7% and 3% is its profit. If the bank were to go and invest all the money in an equity share, and we've seen the variability of returns for investing in equity shares, which ranges from minus 47% to doubling your money, there is a huge mismatch between the liabilities and the assets for a bank. A bank can never function that way. They will have to ensure that they are able to match their assets and liabilities so that they have a steady flow of income which they can use to pay off towards the steady flow of expenses they need to pay in the form of interest to their depositors. Because of which, when a company is looking for capital for expansion, it cannot be only the bank which is its last resort. If it is an established company with a good track record, they will be able to raise some amount of funding from the banks in the form of loan, which the company has to repay. But if the company is a slightly risky business, and that is where they have to go and approach a external investor to invest money in the form of equity. What you need to understand here is, when I as a company borrow money in the form of a loan, I have to repay the loan and I have to service the loan till the date I repay it, irrespective of whether I make profits or not. So if I have a good year, I will be able to service the interest on the loan. But if I have a bad year, I cannot say the person from whom I borrowed money that I will not service your loan today. I will have to service the loan as a company whether or not I make profits. Whereas with equity investing, so if I have an equity shareholder who's given me money, so here I have not borrowed the money like I borrow from a bank, I've taken money from my equity shareholder. The year I make good profits, I can decide to give back part of it in the form of returns, which we discussed were dividend returns. I can also decide that, okay, this year I made good profits, I will not give you any money because I'm going to use the money to reinvest it for future growth. Or if in a particular year I do not make money, I make losses, if something like a COVID happens and I make losses in a year, I can tell my equity shareholders that I will not give you anything today because I did not make anything today. So that is where you differentiate between somebody who lends money to the company who will get a fixed return, low risk, low return, whereas somebody who is invested in a company as an equity shareholder who is participating in the ups and downs of the company. That is why companies need to come to the market and raise money in the form of equity, where they don't have a commitment to service equities in the form of interest on payments, which is called as dividends in the form of equities. Neither do they have the pressure to repay the money, because when you buy an equity share, there is no maturity date for the equity share. The equity share is going to last forever, or rather it is going to last as long as the company lasts. Whereas in case of a loan, the company knows that there is a timer on the loan. They will have to repay the interest and as well as repay the loan once the timer is done. That is the reason why companies need to come to the market, right, and raise money in the form of equity. And that is why we have this entire elaborate trade cycle to facilitate this process for companies to raise money for expansion and also to facilitate investors like me and you to participate in the growth of this company. And this is where we introduce the term IPO, which is known as initial public offer, which is when the first time a company comes to the market and tells the investors that I need your money to fund my expansion. So when the company, which till yesterday was only held by a few shareholders, decides to come to the stock market and say that I want to raise money in the form of equities so that you can participate in my growth and I am having access to your money so that I can grow my business, and you can participate in my growth in turn, that is when the company launches what is known as an initial public offer or an IPO, and that is the first time you as an investor get to buy a equity share of that particular company. As a process, what happens is the company which was private till now comes to the stock market, or what we know as the faces as NSE and BSE. They come and put a proposal to raise money for certain expansion they want to do, and all that information is disseminated to all the investors who would be interested in investing in the company, and then they give their offer to buy those shares of the company. And once those shares are allotted to them, the money goes to that particular company which has raised in the form of IPO, and they can then use the money for growing and expanding their operations. I think it's best if I take an example to run you through this. We are all familiar with the brand name Domino's, which is known for its pizza delivery services. The company that owns the franchisee for selling Domino's pizzas in India, Sri Lanka, Nepal and Bangladesh is Jubilant Foodworks. It is an Indian food services company. Jubilant Foodworks owns the master franchisee rights to set up and run Domino's stores in these 4 countries. Recently, the company also took up the franchisee of another popular brand in the West by the name Dunkin' Donuts. The company was started in 1996 when it set up its first store in India, but over a period of time, it has grown to the size that we know of today. It was not without a little help from investors like me and you. The company came out with an IPO in 2010, wherein they wanted to raise capital so that they could use that money to expand their operations and also prepay some of the loans that were outstanding at that point in time. Jubilant Foodworks came out with an IPO at a price range of 135 to 145. The reason a range was given is because it allows people to bid for buying the shares of the company depending on what they think the company is worth, between 135 and 145. Eventually, the company was able to raise the amount of money they wanted, and it listed on the stock exchange, meaning it traded for the first time on the stock exchange for a price of 161 in February 2010. So if we go back to our investor, that is Arjun, if he had bought 1,000 shares of this company at the IPO price of 145, and he would have paid this money to Jubilant Foodworks in January 2010. At that time, the IPO cycle was much longer. It took almost a month for a company to start trading on the stock exchange after they came out with an IPO. Today, the cycle has reduced drastically to less than 10 days. If Arjun would have bid for 1,000 shares in Jubilant Foodworks and bid at a price of 145 rupees per share, he would have transferred 1,000 into 145, that is 1,45,000 rupees to Jubilant Foodworks, who in turn would have assigned him 1,000 shares, which would have got credited to his Demat account. Now, since this is the first time the company is issuing shares, the company had issued a total of 1.1 crore shares, and now Arjun had bought 1,000 shares, so he owns that much small fraction of the total number of shares of the company because he paid that much amount to the company against which he was assigned 1,000 shares. After he paid 145 rupees to the company in January, the company started trading on the stock exchange in the month of February. So on Feb 18th, the company traded for the first time, and it traded at a price of 161 rupees. So you can see in a short span, Arjun actually made a quick small amount of profit on the shares he invested in this particular company. This is the second big reason why companies come out with an IPO. Apart from the fact that they want to raise money from investors, they want their shares to be traded on the stock exchange among a huge multitude of investors so that the real value of the share can be determined. So while the company thought that 145 was a fair price at which the company was raising money, eventually when they started trading on the stock exchange, they traded at a higher price on the very first day. So when lakhs of investors were buying and selling shares of Jubilant Foodworks, those investors decided that, or those investors who are nothing but collectively known as the market, the stock market, decided that the value of the share should actually be 161 rupees and not 145, because of which they started trading at a much higher price. And so somebody like Arjun, who bought 1,000 shares, was actually sitting with a small profit of 16,000 in less than a month, if he decided to go ahead and sell these shares. Now the question is, should he sell his shares when the company started listing at a higher price? Now the answer to this question is going to be very different from investor to investor, and that exactly is the beauty of the equity markets. At different price points, different investors or different fund managers or different experts, as they call, sitting across and giving their analysis, have different views about the same particular stock. So somebody may think that 145 is an expensive price for Jubilant FoodWorks. Somebody else may think that 145 is a very cheap price to buy the share. And eventually all this collective thought of many people coming together and trying to figure out what the value of the share is what reflects in the trading value of BSE and NSE. So when the stock listed, it listed at the price of 161. If Arjun had sold the share, he would have made a good profit of 16,000 rupees in less than a month. But what if he believed that this company was just starting off, it was having only a small number of franchisees, and it had a huge growth potential, given that we as an India are a huge consumer market? Had he held on to the shares, then what profit would he have made? If you look at the current price of the stock as of September 2020, the price of the stock is 2,347 rupees. So the value of his shares, which was 1,45,000, has gone up to 22,07,000 rupees, giving him a compounded annual return of 32% for his investments in Jubilant FoodWorks. So had he sold off these shares when the company got listed, he would have made a profit of 16,000. But holding on till now would have given him a much higher profit. So whether you hold on to a share or not is a function of what you think a particular share will do. Will it do well or will it not do well? And that is where all your analysis comes in. You need to analyze various factors which go into determining the value of a share. And it is not necessary that every company that comes out with an IPO will succeed. If I give you two contrasting examples of DMart and Reliance Power. Reliance Power came out with an IPO in the year 2008. It was if I'm right, the largest IPO at that time in the Indian market. It came out with an IPO price of 404, and the day the IPO got listed, it got listed at a price of 440. So it seemed at that point of time like a good company which had come out with a IPO raising money for the projects where the company wanted to invest the money was into power generation, because that was the time we were highly deficient in terms of the demand and supply of power in India. But if you look at the current price of the share, it trades at a meager 2 rupees 30 paisa. That means we have lost 99% of the value of the company. If you as an investor had put money in this IPO, you would be sitting with a loss of 99%, because today the value of the share is only 2 rupee 30 paisa. Versus a IPO of another successful company, DMart, which is owned by the company by name Avenue Supermarkets Limited. It launched an IPO in 2017 for a price of 295. The day the IPO price listed, it got listed at a price of 600. That is, the value almost doubled in a span of less than a month. The reason being, the market participants who were buying and selling the share thought that the share is worth much more than the 295 rupees, and that's why they assigned it a price of 600 rupees based on the trades that were done on that particular day. And if you look at the current price of the stock in August 2020, it trades at a value of 2,299 rupees, which is almost a 10 times growth in the value of the stock from 2017 March, when it came out with its IPO, to August 2020. So this kind of gives you an idea of the amount of wealth creation that can happen in stocks, and also the amount of wealth destruction that can happen in stocks if you don't choose the right stock. Hope you enjoyed watching this video as much as we enjoyed creating it for you. So what are you waiting for? Go right now on the link provided in the description below and register for our course Namaste Money. This course is an online course which will teach you all the basics about your personal finances and answer the questions of where you must invest, how you must invest, and more importantly, why you must invest in a particular investment product. Also, don't forget to like, share, and subscribe to our channel for freshly brewed content from Wealth Café. And don't forget to save hard and invest smart.